Part 1. The Awakening of Capital. The ROE Revolution, 2012 to 2015. Let us return to 2012, about 15 years prior to the present. At that time, the Japanese market was, in a word, a swamp of undervaluation, the quintessential value trap. Surprisingly, 70% of all listed companies were trading at a price-to-book ratio, PBR, of less than 1 times, meaning they were priced below their liquidation value. What was the core reason for this? The underlying cause lay in Japan's unique main bank system and the deeply entrenched practice of cross-shareholding. For Japanese executives back then, raising capital was not a process of persuading market investors. They simply needed to visit their primary bank, the main bank, and borrow the funds. The bank's stance was clear. Rather than supporting innovative companies that took risks to generate high returns, they preferred stable, fail-safe companies that consistently paid their interest. Consequently, shareholders were marginalized, and management established the status quo, namely, low-risk management, as their sole objective. This was the fundamental reason why Japanese companies hoarded cash like zombies without deploying investments, thereby falling into a chronic state of low return on equity, ROE. In 2013, the Abe administration drew the third arrow of Abenomics, the growth strategy, to cure this chronic ailment. During this period, a highly significant document in Japanese financial history emerged, the Ito Review. Spearheaded by Professor Ito of Hitotsubashi University, this report delivered a shocking message to Japanese corporations. Achieve a minimum ROE of 8%. If you cannot, you are destroying shareholder capital. This message was revolutionary because it firmly implanted the concept of the cost of capital into the Japanese business community for the very first time. The government officially set a baseline, dictating that management failing to earn the 8% minimum return demanded by shareholders was fundamentally unqualified to run a business. What is particularly noteworthy here is the specific timing of 2013. There was a desperate geopolitical context driving this move. In 2010, Japan's GDP was surpassed by China's, resulting in the loss of its status as the world's second-largest economy. Furthermore, demographic decline had already commenced after the population peaked in 2008. Prime Minister Shinzo Abe's ultimate goal was a strong Japan. But national defense is impossible without a robust economic foundation. At the time, Japanese companies were sitting on over 200 trillion yen in cash without putting it to work. From the state's perspective, the prevailing thought was that national competitiveness would perish if this capital was not unleashed. The government reached the conclusion that companies had to be forced to invest or return capital to shareholders to ensure money circulated throughout the economy. In other words, the 8% ROE target of the Ito Review was not merely a financial objective, but a security-level mandate aimed at enforcing national capital efficiency. However, merely establishing standards does not organically change corporate behavior. Monitors were required. Therefore, the Stewardship Code was introduced in 2014, with institutional investors as the explicit targets. Historically, Japanese life insurance companies and trust banks acted merely as rubber stamps, unconditionally voting in favor at general shareholder meetings to preserve their business relationships with corporations. The Stewardship Code, however, held them accountable to their duties as stewards. It mandated, if you are entrusted with clients' money, you must boldly say no to management that destroys corporate value. This served as the initial invitation that would later prompt global activist funds to begin probing the Japanese market. To summarize, the period from 2012 to 2015 was a phase of replacing the OS, the operating system, of Japan's capital markets. The Ito Review established the 8% ROE target. The Stewardship Code armed institutional investors, and the Corporate Governance Code applied pressure on management. Objectively speaking, however, the M&A market did not explode during this time, primarily because management only feigned compliance with these new rules. This manifested as so-called box ticking, appointing friendly professors as outside directors and blaming external conditions for failing to meet ROE targets. Nevertheless, these superficial reforms paradoxically caused internal fractures, ultimately serving as the catalyst that opened the door to the genuine M&A market. Part 2. Cracks in the Corporate Fortress, 2016 to 2019. After 2016, a highly subtle shift began to ripple through the Japanese market. Outwardly, the number of outside directors increased, and governance reports grew thicker, but investors soon recognized the reality. They realized this was mere formalism, or so-called box ticking. Many companies appointed compliant friends or retired bureaucrats as outside directors, reducing them to mere rubber stamps on the board. From a private equity (PE) perspective, corporate control in Japan remained an impregnable fortress, and sourcing meaningful buyout deals was exceedingly difficult. However, two decisive events occurred during this period that created structural cracks in these solid fortress walls. The first blow was the revision of the Corporate Governance Code in 2018. Prior to this, Japanese companies defended their management control through cross-shareholding, holding each other's shares under the vague pretext of maintaining business relationships. The revised code, however, posed a strict demand: quantitatively prove the cost-benefit rationale for holding those shares. If you cannot, sell them. Following this, global proxy advisory firms like ISS and Glass Lewis sprang into action, beginning to recommend voting against the reappointment of management teams at companies heavily reliant on cross-shareholdings. This served as a critical catalyst, preparing the market for a massive influx of potential listings, an overhang issue that banks and insurance companies had tightly held for decades. So, why was this drastic structural surgery executed specifically in 2018? The answer lies in the massive macroeconomic backdrop of demographics and public finance. Japan's baby boomers, the Dankai generation, all entered their 70s between 2017 and 2019. Consequently, the era of payout dominance arrived, where the number of pension recipients explosively outpaced the number of contributors. At the time, Japanese government bond yields were near zero. Thus, to fund these pension payouts, generating returns from risk assets like equities became imperative. In other words, for Japan's Government Pension Investment Fund, GPIF, one of the world's largest pension funds, to survive, corporations had to increase dividends and boost their stock prices. Furthermore, the Bank of Japan, BOJ, which had been aggressively propping up stock prices since the early days of Abenomics, reached its limit. As the highly abnormal situation unfolded where the central bank became a major shareholder in private enterprises like Uniqlo, foreign investors were urgently needed to step in and absorb the equity volume. Market liberalization was practically impossible without eliminating cross-shareholdings, a practice highly disfavored by foreign capital. The second, and arguably decisive blow, was the Fair M&A guidelines published by the Ministry of Economy, Trade and Industry, METI, in June 2019. At the time, criticism was mounting in the market that management buyouts, MBOs, where executives purchased their companies at bargain prices, were surging, effectively expropriating wealth from minority shareholders. The government determined that while M&A activities should be revitalized, they must not devolve into a private feast for insiders. These guidelines became a crucial standard for the Japanese PE industry because they meticulously outlined the procedures required for deals involving potential conflicts of interest, notably establishing an effective mandate for independent special committees. In the past, a major shareholder could simply dictate a sale at a discounted price. But now, a legal framework existed, allowing special committees to apply the brakes if a transaction countered shareholder value. Thanks to this guideline, the multitude of MBO deals that subsequently flooded the market could proceed with the legitimacy of a fair and transparent process. To summarize, the period from 2016 to 2019 was a transitional phase during which the Japanese market shifted from an era of defense to an era of transactions. Management could no longer hide comfortably behind the banks, and concrete rules were established to ensure minority shareholders could not be bypassed during M&A processes. The fortress walls thinned, and the moats were filled. Now, activist funds that squeezed through these vulnerabilities were fully prepared to upend the Japanese business landscape. Part 3. Activism Rises. The Toshiba Shock, 2020 to 2022. By 2020, the Japanese market was no longer quiet. Shareholders, who in the past merely applauded at general meetings, began taking the microphone to reprimand management. The era of the so-called vocal shareholder had arrived. At the forefront of this shift were activist funds. Not only U.S.-based funds like Elliott Management and Value Act Capital, but also homegrown Japanese activist funds such as Strategic Capital and the successors of the Murakami Fund stepped to the forefront. Their targets were clear: companies with abundant cash that refused to pay dividends, companies holding excessive real estate or affiliate shares unrelated to their core business, and owner-managed companies with opaque corporate governance. The stones they cast did not merely create ripples in a quiet lake. They became a massive tsunami that toppled symbolic enterprises within the Japanese business world. If one had to point out a single event that symbolized this era, it would undoubtedly be the Toshiba crisis. Toshiba was a company that represented Japan itself, a national strategic enterprise spanning nuclear power, semiconductors, and defense. In the past, it would have been unimaginable for shareholders to dare shake up the management of such a corporation. However, in 2021, a buyout proposal from CVC Capital Partners opened Pandora's box. When management attempted to reject it, activist shareholders like Afisimo Capital Management rose up. Astonishingly, an unprecedented event occurred, where the reappointment of the board chairman was voted down at the general shareholders meeting, leading to the ouster of top management. What was the background behind this? The decisive trigger was an independent investigation report. It was revealed that at the 2020 general meeting, Toshiba's management had colluded with bureaucrats from the Ministry of Economy, Trade and Industry, METI, to interfere with shareholders' voting rights. This risked sending a fatal signal to the global market that Japan was a country where the government broke the rules. To preserve market trust, the Japanese government made the choice to abandon an individual company like Toshiba. This was a historic event signifying the end of the too-big-to-fail doctrine in the Japanese capital market. Ultimately, Toshiba was put up for sale as a buyout target, sparking a bidding war between global private equity firm Bain Capital and Japan Industrial Partners, JIP, a consortium formed by Japanese companies which eventually acquired it. The message conveyed by this incident was unequivocal. If even the mighty Toshiba can lose its head for ignoring its shareholders, what about our company? This sense of fear rapidly spread to boardrooms all across Japan. Simultaneously, beneath the surface, the dismantling of defensive barriers accelerated. Between 2020 and 2022, Japan's three megabanks, MUFG, SMBC, Mizuho, and non-life insurance companies, announced plans to sell off cross-held policy shares worth trillions of won. This was because they could no longer withstand the pressure from the corporate governance code and the demands to improve capital efficiency. From a PE perspective, this was akin to the opening of a golden fishing ground for deal sourcing. As large corporations sold off each other's shares, two massive trends emerged. A surge in carve-out deals. Companies sold non-core subsidiaries to focus on their primary businesses, using the cash generated from selling shares. An increase in MBOs. As stable bank stakes exited, executives feeling the threat of hostile takeovers began opting for management buyouts, MBOs, deciding to buy out their companies and take them private. In essence, a massive dam burst on the supply side of the M&A market during this period. To summarize, the situation up to 2022 was as follows. The psychological barriers had collapsed due to the Toshiba shock, and the supply and demand barriers crumbled as banks sold off their shares. Activist funds felt they were nearing victory, and global PEs loaded up trillions in dry powder and flocked to Japan. Now, only one question remained: how to mobilize the remaining companies that were still holding out. The government and the exchange drew their final card to push them to the edge of the cliff. The PBR-1X policy. Part 4. Forced Evolution. The PBR Ultimatum. 2023 to 2024. In March 2023, the Tokyo Stock Exchange, TSE, declared that it would no longer wait for companies to improve autonomously. The core of the request announced at this time was the publication of improvement plans for companies with a price-to-book ratio, PBR, below 1 times. This was not merely a gentle nudge to boost share prices a little. Simply put, the message was, if your stock price is lower than the value of the assets your company holds, it means the value created by deploying those assets is lower than the investor's required rate of return. In other words, you do not deserve to be listed. Armed with this formidable logic, the TSE pushed companies to the edge of the cliff. Furthermore, it executed a name and shame strategy, publicly disclosing a monthly list of companies that failed to submit improvement plans to publicly humiliate them. Why did the Tokyo Stock Exchange take such a strong stance? The backdrop was a massive macroeconomic shift. Inflation. For the first time in 30 years, inflation had returned to Japan. More than half of Japanese household assets are held in cash and deposits, a structure where rising prices inevitably lead to a passive loss of wealth. The core objective of the Kishida administration's New Capitalism and the expansion of the Nippon Individual Savings Account, NISA, a tax exemption system for small investments, was to channel dormant household cash into the stock market. However, if corporate stock prices remained low, citizens would suffer losses even if they purchased shares. Consequently, the TSE's action went beyond merely pressuring companies. It was effectively a social policy measure, mandating companies to boost share prices to prevent citizens' wealth from melting away due to inflation. This pressure created two massive deal pipelines for private equity funds. First, escapist management buyouts. Faced with the daunting PBR-1X mandate, many executives concluded they could not meet the target. Rather than enduring the monthly stress of managing stock prices and being harassed by shareholders, they preferred to delist. Such management teams joined hands with private equity funds and opted to go private. This dynamic was the backdrop for a flood of megadeals worth trillions of won, such as Taisho Pharmaceuticals' 5 trillion won MBO and Benesse Holdings MBO. Second, forced carve-outs. To increase PBR, a company must either decrease its assets, the denominator, or increase its profits, the numerator. The fastest method is to sell off unprofitable, non-core business units or affiliate stakes. As large conglomerates like Hitachi and Panasonic put their non-core businesses up for sale, PEs seized the opportunity to carve out lucrative business units. Adding fuel to this fire was the METI's Guidelines for Corporate Takeovers, announced in August 2023. The shocking message within was that rejecting a serious, bona fide offer for the purpose of management self-preservation constituted a breach of fiduciary duty. The event that proved this was not mere lip service was Nidec's acquisition of Takisawa Machine Tool. Historically, unsolicited bids, takeovers without consent, were considered taboo in Japan. However, Nidec forced through a tender offer despite the opposition of Takisawa's management, and ultimately succeeded. Furthermore, Takisawa's management later reversed their stance and agreed to the takeover, unable to withstand shareholder pressure. This incident left a powerful precedent in the Japanese market that hostile M&As were now acceptable. An environment was forged where companies with solid fundamentals but incompetent management could become targets at any moment. To summarize, the period from 2023 to 2024 was a time when the regulatory blade was actually wielded. The TSE declared, "If you cannot raise your stock price, leave." METI instructed, "Do not block incoming M&A," and the market responded, "Then we will buy." Companies are now caught in a checkmate where they must choose between two options: change themselves or be devoured by others. Part 5. The Great Restructuring and Consolidation, 2025 and beyond. Now, let us discuss the future we will face from 2025 onward. Is the explosive deal flow currently unfolding in the Japanese market merely a temporary phenomenon? I believe it is absolutely not. It is a massive flare, signaling that the entire Japanese industrial sector has entered a phase of mandatory restructuring. If the battle up to this point was fought under the banner of governance reform, the current phase is one where tangible crises, such as an aging population and declining competitiveness, are actively forcing M&A. The most powerful driver is a situation unique to Japan, the era of the Great Business Succession. Currently, the average age of executives at Japanese small and medium-sized enterprises, SMEs, and mid-cap companies has well surpassed 63. The majority of these companies lack a successor. In the past, the prevailing approach was to somehow pass the business down to a son. However, due to heightened governance scrutiny, handing over management control to an unverified second generation has become virtually impossible. Ultimately, to ensure the longevity of their family businesses, founders have begun to accept that selling their stakes to private equity firms is the most rational and often the only exit strategy. This is the fundamental reason behind the structural explosion of small and mid-cap buyout deals in Japan recently. From a private equity perspective, it is the optimal environment to execute a roll-up strategy. The approach of acquiring the leading company in fragmented industries, such as logistics or IT services, and subsequently bolting on second and third-tier companies that lack successors to build scale, is more effective now than ever before. Furthermore, the Tokyo Stock Exchange's name and shame strategy has transitioned from a one-off event into a permanent mechanism of pressure. For companies failing to meet the 1x PBR threshold, only two options remain: voluntarily leave the market through an MBO, a go-private strategy, or hand over management control to a more capable entity, such as a private equity fund or a competitor, a get-acquired strategy. The assets pouring into the market during this process will serve as an immense deal-sourcing pipeline for us. In particular, regional banks and mid-sized manufacturers that are flush with cash but exhibit low capital efficiency will become prime targets. In conclusion, the changes in the Japanese market over the past 15 years can be summarized in a single sentence. The cash trap that confined capital has been shattered, and the channel through which capital flows to its most efficient destinations has been opened. The Japanese government changed the rules, the stock exchange wielded the whip, and the market responded accordingly. Today, the Japanese market has transformed into the most predictable and legally stable market in Asia for global private equity funds, boasting clear exit pathways. The current trend we are witnessing is not merely a numbers game. It is a record of corporate Japan's desperate struggle for survival through restructuring, and simultaneously, it is a wide open door of opportunity for active investors like us. Against this backdrop, in future content, we will cover how the 12 global alternative investment firms discussed in previous videos, alongside another global alternative investment firm employing a different strategy, are operating within the Japanese market. We will also explore which current South Korean policies align with the aforementioned Japanese policies, and what can be anticipated in South Korea based on Japan's policy trajectory. We do not stand at the door. We make the door ourselves. Structure Syndicate, Restricted, IC Feed, End.